Hello everyone, I'm Kim Carrigan. Here are the headquarters of Bankers Advisory in Belmont, Massachusetts, one of the leading compliance consulting companies. In recent years, the federal government has taken steps to make sure that consumers are protected against risky mortgages. One of those steps is the qualified mortgage, or QM. Here to explain is well-known author and CEO of Bankers Advisory, Anna DeSimone. Hi, Anna. We're talking about qualified mortgages. So tell me exactly what is a qualified mortgage?
Well, a qualified mortgage was created by the federal government recently. It's a loan that meets a certain set of standards. And once those standards are met, then it has this classification which makes it easier for consumers to make sure that they're not getting into a risky mortgage.
Now you say standard. Explain what that means.
The standards are some factors that a lender or a bank has to follow. It makes sure that the lender has ensured the borrower has the ability to repay the loan. And the other important standard applies to a maximum of the fees and points that the lender can charge. If the lender can prove that they did this qualified mortgage, then they have a safe harbor, which turns out to be legal protection for the lender for the future.
Now, Anna, you mentioned safe harbor. Maybe you could explain that and explain to me why that's necessary.
It's a way for the bank or mortgage lender to dispose of an allegation that might be made of the consumer quickly and efficiently.
But it obviously has to be documented. It can't be hearsay. It can't be anything like that.
The word that the lenders refer to is memorialize. And what memorializing means is that the lender or the bank has to take steps that they have bona fide proof that they went through all of these standards and qualifying steps to make sure that the borrower has the ability to pay for the loan. They also have to make sure that the borrower isn't paying any illegal fees. So there's another mathematical equation to the safe harbor rule and the QM.
Anna, you talk about these standards, and yet I keep reading stories about how lenders have given consumers money, borrowers money, and never proved that these people could pay these loans back, and ultimately they couldn't.
Over the past year, we probably have a record of about 800,000 borrowers in America who can't afford their payments. And a lot of these have had to go through government-subsidized, loan modification programs. Our country is always doing something great to try to help people stay in their homes. But we also need to prevent this from happening in the future. What these rules do is they will make sure that borrowers are not going to get a mortgage that they can't afford. And so what the standard does is it kind of keeps things into a structured loan that helps the lender in the future with that safe harbor, but also helps the consumer for the getting a loan that they're affordable.
Even if the rate is fabulously low, no one is accusing the lender of making a bad loan, but this law holds their feet to the fire and says you have to make sure that that borrower can in fact pay that loan back.
It's about the affordability of the borrower and the future, the projected payments. I mean, one of the key things about the QM loan is it can't have any surprise features to it. The QM definition comes with a lot of restrictions. It pretty much has to be a conventional loan. It can be an adjustable loan, but it's a certain type of loan, and there are very, very strict rules as to how many points and fees a lender can charge.
We hear about all these crazy loans out there. Is this what they're trying to avoid?
Absolutely, Kim. Yeah. The law very, very, specifically has defined and eliminated certain types of mortgages or types of mortgages from the QM loan. The loan has to be structured so that the borrower has a steady, affordable payment for the whole life of the loan, like 30 years.
Really goes back to the idea of no surprises.
Absolutely. No surprises, no payment shock. And no difficult conditions if you refinance.
The lender really is held to the idea that they have to know that the borrower can pay for this loan.
What they just wanted to make sure that there was pretty much a level playing field, that, why would you have a borrower on one side of town get this payment shock, adjustable rate mortgage with all kinds of strict features if they go to make a change in their life, and then someone with the same income, the same credit, the same ability, the same lifestyle on the other side of town got a much better mortgage. And so what the QM does actually, I think, is create the level playing field here for borrowers.
So we're going to talk about ability to pay because that is a really important subject associated with this whole QM and the whole idea of lending.
The ability to pay, as important as it is to the QM, it also applies to just about all loans.
Now, Anna, when talking about a QM, are there restrictions on the points and fees associated with that kind of loan?
A QM loan has to have a maximum of 3%, a combination of points and fees, and that's applied to loans of $100,000 or more.
Now, Anna, you just mentioned 3% on a $100,000
Yes.
loan. But you also said there are some sub-rules, so maybe you could explain some of that for us.
Well, the sub-rules that go with the QM rules are, applicable to lower loan amounts, but there's a very, very big sub-rule under the QM law, and I want to call that the higher price mortgage rule. Now, under the higher price mortgage rule, in addition to having the restrictions on the number of points and fees, there's also a restriction on what that starter interest rate is that you can charge the borrower. That rate cannot be more than 1.5% over an index called the average prime offer rate.
So does Safe Harbor apply to these larger loans?
You mean the higher price mortgage? Not kind of, sort of. There's something that applies to the higher price mortgage under the QM law, and it's called the rebuttable presumption. If you think about breaking apart the rules, the courts will have presumed that the lender complied with the ability to pay rule for this higher price mortgage. However, because it's a higher price mortgage, the consumer can rebut the presumption. So there might still be a little bit of a court battle there.
Okay, so I'm going to have to ask you to give me a practical example of that.
Okay, well, under the Safe Harbor rule, you have a qualified mortgage. The borrower was not charged more than 3% for the points and fees, and the lender claims they memorialized the borrower's ability to pay. And then later, the borrower finds that they can't afford the loan and they make a claim to court, and the lender needs to make their presentation about how they documented the ability to pay. And as it turns out, I think what happens is things get lost in translation. I think when a lender says, well, the borrower told me they were getting child support income, and I wrote that down on the mortgage application, and I just assumed that when we looked at their bank statements that we saw that money coming in. And the borrower side of the story is, no, the money that's coming into my bank statement is from my job. I haven't received any child support payment. And so these are the kinds of things that can create a problem later on for the lender memorializing. In other words, you have to look under, every stone and make sure that you've captured not only the borrower's income, but the type of income, the frequency of that income.
And if the lender has in fact memorialized it, then is that their way out?
And they just need to make sure that they're memorializing things according to the standards and practices of documenting ability to pay and a residential mortgage loan. And actually, these steps and practices haven't really changed much in the past 20 years.
And a qualified mortgage is a very complicated subject, really, and you've done a great job of explaining it to us. But over and over again, it seems the theme is the borrower's ability to pay.
You're absolutely right, Kim, and we're only talking about the ability to pay and the fact that it's an important criteria and part of the standard. But there's a whole lot more that needs to be discussed about the borrower's ability to repay, and that is a rule in itself.
A rule that we're going to take up in our next segment.
That's right.
So be sure you join us for our next segment as we talk about the ability to pay.